maybe the first thing is we need to step back and say, why aren't they teaching more of this in school?
So we started season 2 of the Meeting Gold show, and what better way to start it with my dad.
40 years ago, $10,000 was a lot of money.
Around 1.7%.
Between 3 and 4.5%.
Watching this market deteriorate down by 4-5%. Stock market is now down
21%.
People were buying that and really went to zero. And all of it came down crashing in 08-09. Really, it affected the confidence behind the banking.
This guy owned coffee shops, shoe shops, where he lost $40,000. Ever heard of the 2008 housing crisis? Well, today, we broke it down. Yes, that's right. It's season 2. We're excited. We're on the stage. We've got our set. And in celebration of season 2, after 56, correct me if I'm wrong, Chad, 56 episodes? 56 episodes straight. We've been posting every day for 5 months. We are now starting a new chapter to the Meeting Gold show, and we're excited because we're implementing new intros, sponsors, and everything else that really makes a show a show. Thank you, Ellen DeGeneres, for the ideas. So with that being said, we've got our first guest, and a monumental one at that, because it's my father, who we brought on a little bit ago throughout the last season, but we wanted to bring him on because he was a big supporter in helping us get to this studio and helping me be who I am, and we wanted to really break that down. But as much as I want to break down the life that we've had, the finances is where he really specializes in, and we wanted to talk about that. So Dad, aka Antonio Giovanni Miele, welcome to the show.
Thank you so much, Samuel. It's a pleasure. And you know what? I'm so proud of Meeting Gold and what you've accomplished. And it's exciting to be the first guest for season 2.
Thank you. So I'm going to go off script here. You started, you were a real estate agent. And a lot of people know that I work with a lot of real estate agents. Mm-hmm. And wait, pause for a second. And then you painted boats. And then you ran coffee shops, shoe shops.
Yes. Well, you got it a little bit backwards. In my early 20s, I started 3 companies in the cafe business, and I was still working in the factory. I had left college. I went for electronic engineering, technologist, and I just hated it. I couldn't stand it, and just was a little bit lost. You know, I'm 20 years old, and I got an opportunity to work in a factory, make some good money. I thought, okay, I'll work there for a while and then go back to school.
So you dropped out.
So I left Niagara College. What ended up happening was this insane drive to start investing. And I started making some decent money, and I started investing at a very young age, buying my first property actually at 19 years of age, and then opening up 3 companies over the time between 23 and about 27.
One of the biggest things we talked about on your last episode with us, and we don't really have to get too much in depth if you want to check it out. It was a couple episodes ago, but your shoe shop.
Yes.
And what you learned from that.
Yes.
Now, real quick, give us a summary again of what you kind of took out of that experience. First of all, what happened?
Yes.
And talk about that.
Well, you know, when you're young and full of vinegar, pea and vinegar, as they say,
Like me.
Be polite. You know, relatives in Europe owned a shoe factory, and I thought, wow, you know, bringing great shoes to Canada, and you know, stepping way out of your comfort zone, but I thought I could pull it off. And you know what? By and large, I did all the things right, but at the wrong time in the wrong place. It would have done great in maybe like Toronto or New York, but the high-end quality of shoes just would not take off here. And it was a very, very big learning lesson. In fact, a learning lesson that I never forgot all these years, and I use that as a stepping stone or milestone as to how to measure things. And when I'm getting off track or getting a little bit too excited, not doing my homework or analyzing things to the point where, okay, I've done my homework, my due diligence. I think I got a little bit excited about the opportunity and maybe thought I could pull it off. And again, it looked great. The store was beautiful. It was called Manhattan Footwear, and it really was, but wrong place, wrong time. And that was a big financial learning lesson.
I got to ask, how did you not, or I guess, do you allow that to instill fear in your current investments, or allow that maybe, because fear is a good thing.
Mm-hmm. If it's inappropriate.
Right.
If it's appropriate measure. I would say there was some fear from that. Of course, that would be natural. You're 27, 28 years old and you lose a lot of money. That was a big learning curve, but it was healthy because it helped me to start logically rationalizing things. Now, again, it might have stopped me from doing a few things, but in retrospect, it was a very hard lesson, but a good lesson.
I think it's important that people have a little bit of fear in them. It's kind of like the saying, desperation breeds success. If you're not desperate, that lack of urgency and that sense of urgency, it will just not be there. It takes that for it to really push you, is that sense of urgency.
I would say, again, make sure you do your homework. Make sure you look at something methodically, but also step away and maybe get some more input from others. And I think I would have learned a lot by asking for more advice from people that maybe were not connected with me personally, but outside of my realm, that maybe give me a different viewpoint. And then maybe I could have reviewed the situation differently. But life is about learning. And as many successes I had, that was the one failure that I would say that taught me many lessons.
And your, I don't know if you want to get into it, but like when you bought options and you got burned one time.
Well, you know what? Yeah. I mean, I had a small options account and I remember losing, a lot of money, 40 years ago. 40 years ago, $10,000 was a lot of money.
Yeah, that's like 40, 50 grand now.
And probably, yes. So you learn that too. So, all these things are things that you learn, but, take those as a good experience, a lesson learned. And ultimately, people can get down or depressed. But you know what? Those are good learning lessons. And you know what? If you're strong and you're committed and you're disciplined, you learn from them. And I wouldn't trade them for the world now.
So we'll get into you today. You've been a certified financial planner with IG Wealth Management for...
I'm going in my 28th year. September will be my 28th year.
That's right. You got the 25-year watch, right?
Yes, I did.
You had a watch choice. You had what else? What choices did you have?
A few different things, maybe.
Yeah, and then mom bought you a watch.
Yes, yeah. At the same time.
At the same time for your birthday. I want to talk about the qualifications you have as a financial planner. Basically, just a quick summary on your experience, what you know, just real quick.
Well, a certified financial planner means I've spent a lot of quality time in learning my craft. It is a worldwide designation, and it's considered, the standard for the top advisors in Canada, United States, and around the world. So I also am certified in the aged, meaning I've actually taken programs and studies to make sure I understand about the aged in Canada and understanding their needs and the areas of concern around our aging population. So, these are things that are, if you want to be good at your craft, you're going to have to spend a quality time. And I've done more education in the last 20 years than I did when I was 18, 19.
Right. I want to ask, because you talk about like the education aspect of finance, and I find a lot of people aren't educated in finance, me being one of them, in the sense where there's so many complicated things. I remember trying to go through that mutual fund book, and there's so many little just complicated things, but positive things at that, like little loopholes that you can utilize, things that the government allows you to do that people don't even know, where they could actually save a couple $100 here, a couple $100 there, So talk a little bit about why finances are so confusing to people and what people can do to get themselves a little bit more self-educated in financial planning or just understanding why money is so important to understand.
Well, maybe the first thing is we need to step back and say, why aren't they teaching more of this in school at a young age?
It's very unfortunate.
So maybe starting in grade 7 or even younger, learning about saving, learning about, budgeting, learning about paying small bills and maybe using some techniques to do that. But at least at a grade 7, I think the concepts of solid financial planning should start. Meaning, if something costs $1, I have to go to work for that. How do I, budget for that? And I have to pay my other bills. So learning those little simple things. But the other thing too is people are scared to talk about money because maybe some people grew up without money, or some people have too much money, or some people just don't know how to have that discussion. It's like that odd conversation, right? But the sad part of it is, if you can demystify money, then you can understand it. Then you can implement strategies, because really it is like a chess match, right? Understanding government legislation, understanding the tax rules, and utilizing them to your favor. And really, knowledge is power. And so really understanding investing or understand. And then really the other thing is, all the misunderstandings about money, all the get rich schemes that, you see on especially nowadays with, social media. Yeah. And so people are always looking for a next quick gimmick to make money. Well, there is no real quick gimmick, going to a casino is not investing. That's gambling.
A lot of people equate, and it like,
yes,
I have to hold my tongue back, because a lot of people equate the casino and gambling with the stock market, and
isn't that crazy?
It is, yeah.
Really?
But see, I don't think we can say that it's crazy, because if you grew up without an understanding, like if I grew up with, like, let's face it, if I grew up with a father who solely invested in real estate, what do you think I would look to invest in?
Well, of course, that would be natural. But of course, investing is all those things. Investing is real estate. Investing is liquid assets such as stocks and bonds and cash equivalents. Investing isn't one or the other. It's a combination of all of them. So a good investor is well-rounded. It's not one or the other. It is a combination. I believe in solid assets, liquid assets. So this is not maybe one or the other, but you mentioned something very important. To really understand investing, you must demystify it. And so you have to break it down. It's really about consistency and understanding in a diversification, meaning this: if I invest in great companies that are in North America, such as Home Depot, Costco, Walmart, the banks, whatever, I have the economy. Therefore, the economy runs regardless of inflation, regardless of interest rates, right? So you're still going to go to Home Depot and buy that piece of wood if you need to do that project, right? You're still going to fix your bathroom. You're still
going to buy a new phone. You're going to buy a car.
You're still going to go to Costco and buy groceries. You're still going to go to Walmart and pick up items. You're still going to put gas in your car. You're still going to, turn the lights on. These are things that, there was a great quote by Jack Welch, the economy was 17 trillion and we spend 16 of it, right? Meaning money is generated and put back into the economy. So if we believe and understand that, companies will always make their margins. But what we have to understand is we need to get rid of this mindset that investing is only for the wealthy. It's not. It's for everyone. And information is the key barometer. The more information you have, the more clarity you have, the more order in your investing, the more logical you're investing, the more rational you're investing, the less emotional.
So that's a great point. How does emotion affect people's buying habits and selling habits?
Yes. Well, I would say the biggest destruction of capital is the lack of emotional discipline in investing. There was great studies where, say, the market has averaged 12% for 100 years in the United States, but the average investor only makes 3 or 4. Why? Because they're buying at the wrong time and selling at the wrong time, right?
And that's because of emotion.
Emotion, right? And so, I'm just watching recently Warren Buffett. He's 94 years old and he's just buying great companies at a major discount right now. And he's 94, right?
So he won't even see the reap of profits from that.
No.
He'll die before he...
Right. But he says, this is the discipline, right? So if I believed in great companies before, why wouldn't I buy them at a 20% discount?
Everybody's going to have, like, the biggest example you told me, and what I really try to relate to the people my age, is that, investing is not for me. I can't make any money in it. I just got burned. I said, listen, what do you have in your pocket right now? They pull out a phone. Everybody pulls out a phone. All of North America pulls out a phone.
Yes.
That's 300 million people plus. No, 400 million people plus majority of which have a cell phone.
Well, 6 billion people around the world have a phone now.
Really?
6 billion.
Wow. And there's
8
that's
billion
crazy.
people.
Shout out to a good friend of mine who actually asked me to ask you on an episode. I have it written down: life insurance versus mortgage insurance. The differences, why you would buy one or the other, and try to give it as unbiased view as possible.
Well, actually, there is no bias or unbiased view. Understanding the differences is key, because life insurance is a contract that you purchase through a licensed insurance company, whether it be, there's several big ones in Canada, but mortgage insurance is actually underwritten at the time of the death or a claim. So the difference between the two is a private personal life insurance policy that you own is underwritten before they give you the policy. Meaning, once they give you that policy, it's yours.
And do you reap the benefits of that while you're alive in some way, shape, or form?
No, unfortunately, life insurance is designed. Now, let me explain the standard process without getting too intricate about life insurance. If I buy a term policy, that term 10 or term 20 policy, meaning in those time frames, I'm covered, right? But I've been underwritten. Now, there are some clauses like suicidal clauses, like for the first 2 years and such like that. But basically, you've been underwritten at the time you applied for the policy. Whereas mortgage insurance is underwritten at the time of the claim. So if you have only mortgage insurance and you pass away or your spouse passes away, that's when it's underwritten. Well, what if there was a question that you didn't answer correctly on the mortgage application for the mortgage insurance? It could actually detrimentally affect you. You might not get your mortgage insurance.
Can you give us like a number example, like $1 million life insurance, $1 million mortgage insurance? I'm not sure exactly how that works, but
Right. So remember one thing: a personal insurance policy versus mortgage insurance. A personal insurance policy stays the same in value. Meaning, if I bought a $100,000 policy, 8 years from now, it's still $100,000, where mortgage insurance covers the mortgage balance. Well, as you pay down your mortgage, what happens to the mortgage insurance? It's reduced. Now, that's fine and dandy to pay off the mortgage, but it might not help your wife and kids.
interesting.
How are your wife and kids going to? So we do an insurance needs analysis. So the difference really, I would say, is that mortgage insurance, I mean, it's still a stopgap measure, but it's not what I would consider the best type of insurance. But it does fill a gap. But it's not what I would recommend for a proper insurance portfolio.
Now let's adjust topics here. One of the biggest movies that discussed the crisis of 2008, The Big Short, which received 89% on Rotten Tomatoes in reviews by over 500,000 people. Explain to us what happened in 2008. Why did it happen? And are we looking at something similar to that again with the economy?
Well, good question. Let's look back what happened in 2008-09. There was a move to create more housing for people in the United States. And there was a mandate to create more housing, and there was very lackadaisical underwriting. What does that mean? People were going to the bank, okay, and they were buying a $500,000 house. Well, they hadn't worked in a year or two. Well, when you worked, how much did you make? Oh, about $50,000. Oh, really? Well, how much you got put down? Oh, 5%. And they were flipping, and they were flipping, and they thought, wow, I can just get in and get out, get in and get out. And it was like easy money. The problem was there was a lot of fraud in the mortgage lending. Unfortunately, like anything in this world, when there's fraud involved, you get chaos. And what occurred was really a housing market and banking underwriting that went crazy. What really was the scary part was the banks and other companies, I believe, tried to, well, I shouldn't say I believe. I should say what they were saying was they were packaging these bonds and all these mortgages and all these bad loans into a box and selling it to somebody else. Well, they were selling it to somebody else, but they never looked inside the box. Could be bad credit cards. It could be in third mortgages, second mortgages. Could be, loans that were like just really almost garbage. And people were buying that and really went to zero. And what happened was this came back to roost. And all of it came down crashing in 08, 09. And then really it affected the confidence behind the banking. And, Lehman Brothers went under and many other banks survived by the skin of their teeth. And it was required a major input of money from the governments to save the banking industry. It was a very, very difficult time. Now, what did that have to do with the average investments, like owning good companies? Nothing, but it affected the economy. And it really put a real damper in the economy because people had lost a lot of money in housing, lost a lot of money in different areas, and people's businesses went under. And what happened was that deleveraging it was just absolutely insane. And what it did was, it affected the economy for about 2 years. But then you've seen a strong rise out of that in 10, 11, and 12, and 13. So, these happened like in 2001, 9/11, 2000, the tech bubble, and, in the 90s with the Asian contagion, in 1987 with the Black Monday. There's always something. People forget at the beginning of COVID, the markets dropped about 20%, but they recovered in about 4 or 5 weeks. Right?
Emphatically.
It was crazy. It was like a V recovery. But people forget about that. So market conditions aren't always positive. In every 10-year period, you might have 6 good years, 4 bad years, 5 good years, 5 bad years, 4 good years, 6 bad years. But the markets tend to average between 9 and 12%. Now, that is fully invested in the market. If you're more a moderate investor, you're going to make, a fair return, say that 5 to 6% return.
So what happened in 08 and 09 was that, correct me if I'm wrong, banks were relying on people who were not bringing in enough cash flow to pay off their mortgages, of which those people weren't paying their mortgages.
Well, no, it gets worse than that. Mortgages were given to people who should never have had a mortgage, and mortgages were given to people that were more than what the house was even worth.
Wow.
So it was money lending at an extreme, and the fraud involved in that. And that's where, the movies like The Big Short, played on all that.
Because basically the guys at the top got their commissions and the people at the bottom got their houses. Everybody was happy. And unfortunately, in a world like how this runs, when everybody's happy, something's going wrong.
Well, look, it was a very complicated, we're trying to simplify a major thing that happened in 08, 09. But, again, when policies and bad apples, you get situations like 2008, 09.
Interesting. That actually brings me into my next topic, because now we're starting to see something where everybody's getting happy, and then they're always the losers. I have it written here, the big losers and the big winners of crypto. So we've seen, let's use Dogecoin as an example, right? It gets pumped up. Everybody seems to be happy. Everybody's buying. But then the people who bought at the top don't realize that they're buying from the people that know that it's going to crash. And what's unfortunate is everybody acts like they're working together, but at the end of the day, somebody's got to sell it to the next, sorry to say, but I don't know if this is proper, but somebody's got to sell to the next stupid person who's going to buy the pump.
Well, unfortunately, blockchain is the big winner, meaning security, encryption of data, which is good for the banks, good for many industries, the medical industry. The unfortunate part is in cryptocurrencies, there's so many different cryptocurrencies, and what is the legitimacy and what is, where does cryptocurrency play a role down the road? Well, we see a trend towards governments going to digital currencies. This will probably happen in the next 5 or 10 years. But what is the currencies and what does cryptocurrencies have in common? I don't know. The jury's still out on that. I don't believe that the government of the United States is going to use some existing cryptocurrency as their currency.
Yeah, that's actually, I want to talk about that. And I'm not sure how in depth we can get about it, but a lot of people believe that, Ethereum or Bitcoin or these coins, these cryptos are going to be utilized by the government. Is there a potential possibility with how these cryptos are laid out that the government will somehow take them over? Or will the government look to start a new crypto on a blockchain of which it will be as stable as the current dollar?
I don't believe, and this is just my personal opinion, that any government in the world would not want control over their currency. And so just my humble thoughts, again, it's just a professional guesstimation, but a government is going to create their own currency and they're going to back it with their own stability of their own countries, be it Canada, be it United States or Europe. So you see, in China, they have the digital currency already. That's already in play, where Canada, United States isn't there yet. There's a lot of things to be worked out, but blockchain is one positive thing out of all this technology that is going to help protect data and make things safer. However, I don't think any government is going to give control to any other digital coin, and I don't want to mention which coin because it's irrelevant. The governments want to control their own currency.
Which is very fair. I mean, we've seen that through centuries
Right.
of different governments from the time of the Romans to even before then, right? Starting their own currencies, whether it was gold or silver or today's dollar. Yeah. We've seen people, the government, want to take control. And in some ways, that's actually not a bad thing. Look at how volatile the crypto market has been, and it's because it's not controlled by any central power. It's controlled by the thoughts and opinions and views and outlooks of the people.
Well, many would say that's why they like it.
But
right.
Which is fair, and that's actually an interesting topic because I don't think a lot of people understand when there's no central ideology or central rules. And as much as people hate rules keep things in check.
And remember, we're probably in the first or second inning of cryptocurrency and digitalization of currency. So this is still, and I'm not an expert at this, so I'm just sharing my own personal opinions. We're still in the early stages, but the technology of blockchain will be here and will be the basis, I believe, for securing data and digitization and ensuring that there's some kind of coverage. However, that does not mean that cryptocurrency in its present state is going to be the end state. I believe there's going to be many, many evolutions of cryptocurrency. And what that looks like, I don't think anybody really knows. You can guess, but I still say no country is going to give up control of their currency to some digital coin that's existent today.
And that's very interesting because even you look at the evolution of the dollar. I mean, it started as just trading items to cavemen trading wood for brick or clay for metal or rock or whatever that may look like, and then it slowly evolves into what society deems valuable. And I don't believe personally that society does not in a whole or majority enough value enough crypto to utilize it or to label it a stable currency. But we will hopefully see that soon.
I think, like you said, go back 4,000 years ago. 4,000 years ago was a barter system. I give you a sheep, you give me this, and I give you corn, you give me something else.
Exactly.
I'm not sure when currency started, probably in times of Persia and probably about 2,500 years ago. So currency's been around for a long time. The Romans had currency, the Greeks had currency, and I believe even the Babylonians had currency. But quite honestly, the method of now using money, but the next stages of money will be, I mean, really, let's be honest. Most people just use a debit card now.
Yeah.
So isn't that a form of digitization?
And nobody's ever, I can only imagine, I wouldn't be alive by then, but for you, back when you were just a kid, debit cards and credit cards were they even...
There was no such thing as a debit card.
Exactly. So you see that evolution of currency, and it's very interesting to look back on how, yes, I almost compare it to a world without time, it is unimaginable. A world without currency is almost unimaginable to society to this day.
Yes, it'll be massive changes, massive,
There would be
confusion.
there would be no control.
Right. So there'll be a big curve, but you know what? The way the world is going, it looks like it's going that way.
For sure. One of the things I didn't ask you, and this is kind of jumping back to what we discussed about the stock market or the market in general. A lot of people ask, or even my friends of mine, and I'm not educated enough to give a professional opinion, but a lot of people ask, hey, what should I put my $5,000 into? And they want their money to move without doing much. They want to make money while they sleep. And it's something that's empowering to have your money be moving consistently, when you are asleep at a young age of 16, 17, whether you're, really not supposed to be, but investing through your parents or whatever that may look like. Mutual funds, ETFs, simple stocks, options. You've got a variety of different GICs. You've got a variety of different options that you can choose when investing. What, if there are any specific best ways to invest your money as a young entrepreneur, as a young person, as a driven person, where can I look to do that?
Well, I would say this. Any young person listening to this podcast, take your money, put it in a very solid, diversified mutual fund with a good company or an ETF with a good company, and consistently put money away.
Even $100 a month.
Even $100, $200 a month away. And I'll tell you, you'll be so far ahead of the average person that it will be mind-blowing. And ultimately, in the end, I can only say this as a 60-year-old man now, that those qualities, looking back, they are tried and tested. Listen, money is working while you're sleeping. Remember something, if I own the banks and own, big corporations, right? Like Walmarts and the Home Depots and the Costco's and whatever, Microsofts and the Apple computers, that money is working for me while I am sleeping, right? But having professional money management is absolutely crucial because they're going to keep you from making the big mistakes. A good financial advisor will guide you and keep a hand on things and keep you from going too fearful or too greedy, right? And I believe that 100%, that a good active managed portfolio of either ETFs or managed money, and I'm preferences for managed money because like anything in life, why wouldn't I want professionals working behind the scenes on my portfolio?
Same idea behind a real estate agent, same idea behind an insurance broker, a mortgage broker. Right. Realistically, you could try to do a lot of things yourself, but how much of it do you trust, right?
And you know what? You're busy working 40, 50 hours a week. I need somebody who's doing this 24/7, right?
Right.
And what in the world? I'm going to pay a small stipend for an advisory fee. I mean, I don't go to Walmart and tell the girl, how much are you getting paid? And I'll decide whether I want to pay you now.
It's actually very interesting. You see this a lot where employees of companies think, oh, they're making so much off of me. And it's a very interesting idea. I'm glad you brought that up because, as a small business owner, I've had people in the past where, you're making money. Why am I not making as much as you? I'm doing a lot of the heavy lifting. And that idea, for whatever reason, is not carried out through, Walmart when you are an employee at Walmart, just when you're a small business doing okay. It's a very interesting topic.
There's a lot of psychology behind that. I would like to say this. To be an entrepreneur, you have to take risk. You're putting up your own capital, your time, your effort, and you have a vision and a goal, and that the world functions on capitalist dreamers that are out there willing to risk their own capital to build something. And those are the ones that create the jobs, right? A Ken Langone created Home Depot with another gentleman, right? And now look at it. They employ half a million people, right? Apple employs 700,000 people. Amazon employs almost a million people. And you think about it, these were created in dreams and visions from one man.
It is crazy to think about. You see these massive companies these massive companies.
They were an idea once.
They were literally just an idea. And
Yes.
that is, if you really look at that and break that down, it's astounding.
It's astounding because the execution on the idea is the key. The idea is always wonderful. I've heard great quotes on, idea without any execution is just an idea. But
Kevin O'Leary says something similar.
But I mean, an idea with discipline and execution is, wow, powerful. And so whether it's starting a new, a technology company or a social media platform, a financial firm, whatever. I mean, these are people that have ideas that stepped out and created and then moved it to another level. Ultimately, as well as an entrepreneur, entrepreneurs are usually natural risk takers. Now, I don't say risk taker in the sense, jumping out of a plane. I'm talking about risk takers saying, you know what, I'm willing to work really hard to have this dream come true. Now, that doesn't mean they're always successful. But if you look at how many great investors we've had over the years, in the last 100 years, many of them went bankrupt 4 or 5 times and made it on the 6th or 7th time. Now, I don't know how many people can handle that, right?
Yes, yeah.
I mean, that's got to be, profound to just deal with that kind of failure. But again, we think about, the Amazons, people forget, it didn't really do well in its first 5 or 10 years.
It was a book company.
Yeah. But it was morphing into something else. And the people who bought into his dream, in Jeff Bezos' dream, then reaped from that. And it's the early investors that made the big money.
I think from my experience being a young entrepreneur, you realize more and more that people invest in your ideas and they invest in you rather so than investing in the company. And what's crazy to me is there are companies like Apple where I wouldn't invest in it because the CEO is the CEO. I would invest in it because it's Apple. However, then you look at how somebody builds their personal brand, such as Elon Musk, and you say, I trust Elon Musk because he's a risk taker and because he's made it through tried and tested errors and challenges and extremely hard times, to where I want to invest in his companies because I believe in him.
Right.
How do you go about, as an entrepreneur, allotting people and giving people that reason to trust you, not just the company?
So let me explain. A great company, a great mutual fund company or a great ETFs company, they do their homework. And so we analyze the ownership. We analyze the structure of the company. We analyze the customers. We analyze their cash flow. So imagine there's probably 40 or 50 parameters that are measured before they invest in a company. So all that dirty work is done by somebody for you for a small stipend. You have to ask yourself, wait a minute, I want those guys on my side, right? So you mentioned Elon Musk. What a great story. A great mind that's created great ideas, that's actually made space travel more affordable than what it was under NASA. So
As a private company.
As a private company.
As a private
Right.
company.
But we have to remember too that he's also got public funding, right?
Interesting. Whereas
Right.
NASA did not.
Well, NASA is all public funding, right? But remember something, there's also an opportunity for personal gain. And so people are driven by that. And, human beings are always moving towards improvements. So the space industry has, jumped leaps and bounds over the last 10 years. I mean, look what they're doing with, their rechargeable rockets. And I mean, my goodness, the money that they're saving on all that is immense. So, but it took a mind to create that. It took engineers. It took a team. It took thousands and thousands of man hours, right? How many people are willing to sacrifice that? I hear stories like guys like Elon Musk sleeping in the factory, sleeping in the factory, working 80, 90 hours a week, 100 hours a week.
That sacrifice pushes people. Yes. And that's where I think what we discussed actually right at the beginning of the show was Desperation breeds success, and it brings a sense of urgency.
But I want to make one thing clear. It's not that Elon Musk needs more money. Elon Musk is driven by the idea of something greater to change society. And if you can find that passion and that purpose, then it's not about the money. It's not about the money at all. He doesn't need any more money. But to be the person to change space travel, to change a car, to change society, that's a legacy. That is somebody that legitimately will go down and remembered as somebody who was a instrumental human being in changing society. And I think they're driven by that.
I think that's very accurate.
Yeah.
We're going to have to end the show today, but I want to ask, where can people find you and reach out to you on a personal level?
Well, I'm at IG Wealth Management. It's Miele Group Private Wealth. We're at 210 Martindale, St. Catharines, Ontario. And as always, I share my cell phone, 905-704-8011. But ultimately, in the end, if you're somebody that's serious about finances, serious about making change, and you want advice that is holistic and encompassing everything, then a good advisor is somebody you should look at. And a certified financial planner is a designation you can count on. Now, I would say personally, for me, the passion and the purpose is really being a person that can come up with solutions and ideas to bring change to a family. Just like we talked about change to a society, well, maybe I can make a change to that family, right? To be the person to bring solutions to alter that family's destination, to become everything they wanted to become for their family, to preserve their capital, to protect them from taxes, to protect their family if, God forbid, anything ever happened to them. That is really a well-rounded, holistic financial planning process.
It's like a right-winger guy who's right-hand man when you need him. That's it.
No, right-hand man, advisor, advocate. Advocate is like your lawyer, right? It's a Latin word for lawyer.
I appreciate that. Well, Dad, thank you. Tony, Miele, thank you so much for joining us on today's show. Yep, we just announced season 2. I hope you like the new and updated looks that we're going for. Hope you appreciate the empty abyss of the stage we built and slaved over, and the amount of wood that was put into this, and how solid the floor is. Hope you can see you guys in the next episode of the Meeting Gold Show. For now, that's it. That's all. Thank you so much. Peace.